Hi, everybody. This is our look at the week ahead brief, where we're going to take a look at a setup in gold that's got bullish indications. I'm going to take a look at oil, what's happening there, and we're going to take a look at natural gas. Big week for the UK, of course. On Tuesday, the UK reports out industrial production and employment. On Wednesday, CPI and PPI. French also on Tuesday report their NFP, and Wednesday's the U.S. Crude oil inventory. But the big deal is with the U.K., these are big important numbers for what probably is going to look like a further buffeted and banged up U.K. economy. And the natural gas picture, which we're going to take a look at on a harmonized basis to try to remove some of that annoying confusion between the different. Well, we'll get to that in a moment. Let's take a look at what's happening in gold. This is a Fibonacci retracement drawn from about I guess it was about August of 2020, where gold hit its 2200 mark or so, and its low, which to date was 1628 handle. You'll notice that it's broken through and is staying consistently above that 38% indicator level. It's now well above, it's 1810, the 32 is 1800. We're going for 1853, 1850 or so. Once it hits that level, 1849, 1850 or so, stays above that, you get the idea. So these are the Fibonacci tracement levels, and you see their efficacy. It held 3 times here. Spent a lot of time bouncing around the 23 level. This is a classic retracement according to Fibonacci. So we're looking for continued upward movement. I also want to point out that continued upward movement in gold is backed up by increased average volume and increased volumes, indicating sentiment behind that. The Force Index verifies that observation as well. And for a change, the commitment of traders reports have the large speculators net long, so that's always a good sign. That's lines up the stars, as it were. So gold looks like it's on the move finally after doing a lot of nothing for a long time. Gold is looking like a very positive setup. The next thing I want to take a look at is crude. Now, crude is wacky. Crude price is falling. It's falling from a high of 122 last June to today's price of 71 and falling. While the large speculators are net long in the face of falling prices, that has them on the wrong side of the trade for sure. As does it have the commercial hedgers as well. So price is falling. Now what's going to drive this around? I mean, it's way below. It's miles below the 20, the 50, the 200 for sure. This is a daily chart. So OPEC agreed to do nothing last Sunday, but they still have the August production cut of 2 million barrels. So that's going to take time to institute. And if the China opening up increases demand for transportation fuel, which we assume it will, sooner or later these people are going to start shipping out goods and services. They're going to have to be trucked and shipped and what have you, and delivered. Then the demand for crude oil is probably going to go up. But in the meantime, it's falling. So all we can say is keep your eye on it. We don't recommend a short position in oil because we think the fundamentals should be reversed. But the market is not behaving in a normal way, so we will avoid taking positions. But it's certainly something to be aware of, because we do think that it's going to return at some point and head back up to the $100 neighborhood. It's our speculative opinion. The last thing I want to point to in terms of the trade is this is a comparison between the U.S. natural gas, indicated here with the standard candlestick, and the European Dutch TTF contract here. And the beauty of this chart is it's been harmonized between dollars per million BTUs, which is how the U.S. contract is stated. We transformed the Dutch contract, which is euros per megawatt hour. We transferred that euros to dollars again and back to millions of BTUs. And you can see the price differential is astonishing. U.S. gas trades for $6.50, call it $6.50 a million BTUs. And the European gas trades for $43. That's 8 times the cost. So it's our contention that the huge demand for gas in Europe, if it probably can't be met entirely, even significantly, well, hopefully significantly, but this is what we do know. The pipeline network that has been feeding Europe for the last 30 years is defunct. It's kaput. There's nothing flowing through it. It's either been sabotaged or shut down. The alternatives to that pipeline are shipping it in tankers in liquefied form. It has to be regasified. And the current facilities for that are woefully underinvested is what they are. There aren't enough. The main ports of liquid natural gas reception are in Spain and Portugal. Portugal, yes. And those ports are not, those offshore storage facilities are not connected to the European network. I don't know where they go, but they don't connect into the network because that network that feeds Europe flows from the Urals in from the east to connect to Europe. There's been a delay in the floating regasification plants that Germany has sought to anchor off the shore. The ones that they're building onshore permanently, like in Portugal and Spain, won't be ready for at least another year and a half perhaps. And the Americans are shipping as much of that stuff as they can possibly load on tankers. That's the bottleneck, by the way. The Americans are producing tons and tons of gas. They're currently, I believe, the world's largest single producer of gas. I could be wrong about that, but I'm pretty sure it's true. But, those numbers vary every couple of months. Who's the biggest manufacturer, Toyota or Volkswagen? I don't know. It changes about twice a year. But our contention is this. You can see the volume. This is a daily chart, by the way. So it goes back to this huge jump, goes back to about the middle of October. We're talking about, about 6 weeks long now. And this also is due, in no doubt, to this weakening, the sudden weakening of the U.S. dollar in the face of what was perceived as good inflation news and therefore potentially good interest rate rise, slowdown in interest rate rise news. That will only be known come the December meeting of the Fed, which is a couple of weeks off yet. But in the meantime, demand for gas is going to soar. And somehow or other, some of that gas is going to seek to be replaced by the U.S. market. And the differential seems to indicate that a lot of that purchasing is going to be placed in the U.S. at that lower price, despite the shipping cost, which will be quite high in getting it over there. So we see we see a lot of the sentiment behind this. Our statement certainly would back that up. Pardon me, please. But again, the large speculators are net short, and deeply so. Again, that's for what it's worth. In this case, I don't think it's worth anything at all. That indicator is not right all the time, or perhaps even half the time. But it's just a backup. If you don't see it, it may not take away from the wisdom of the trade. If you do see it, it perhaps might add to the wisdom of the trade. Hard to know, but it's a weak indicator is what I'm trying to say. The easier indicator is your volume. But what I also want to say is this. What we notice here is that the U.S. gas and the Dutch gas, the TTF contract, again, the green is the Dutch and the candlestick, I'll blow it up a little bit so you can see a little bit, is that U.S. gas traded Henry Hub. You'll notice that they're nearly, just I haven't run the actual analysis, but they're nearly 100% correlated. Certainly from the middle of July, they're entirely correlated. I guess that's when it became clear that the gas was being weaponized. So they're fairly correlated for interchangeable from aspect of view. What we think is going, what we expect to happen based on meteorology or the war, the NATO-Russian war, affecting European gas, seems to have an identical effect on U.S. gas, plus minus. So that's a useful piece of knowledge in and of itself. So we're going to be focusing on the UK. We're going to be focusing on the gold and the natural gas. We're going to be keeping an eye on the oil. And just let me say that, the oil inventory report, we're expecting another decline. We've had a few declines lately. I don't know what that's worth particularly, but that's what we're expecting, at least another forecast of 800,000. Another 800,000. I'm sorry, by about 800,000 decline. So, ladies and gentlemen, that's going to do it for this week. I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.